This is Freedom Investor Radio, and I'm John Pearl. It hit me like a freight train when I realized there was a better way. When I discovered that I could take my future into my own hands. When I realized I could invest my way to freedom. This is what I'm working towards. In each episode of Freedom Investor Radio, we will explore the tactics and strategies used by the top real estate investors and entrepreneurs in the nation. We will learn how you can start investing your way to freedom and take control of your life. Thanks so much for tuning in. What's going on, everybody? Welcome back to another episode of Freedom Investor Radio. I'm your host, John Pearl, and today I am joined by Jonathan Nichols, who is the president of Apogee Capital. Jonathan, welcome to the show today.
Hey, John, thanks for having me. Excited to be here.
Yeah, absolutely. Jonathan, I'm going to just pass it over to you. Why don't you give us the high level of what it is that you're doing now and how you got there?
Yeah, absolutely. So it's making a long story short, my wife and I, Paula, we got married about 5 years ago, a little over 5 years ago. And she informed me one day shortly after we were married that we needed to find a hobby together, something to do that we enjoy. And at the time I was like, what are we going to do? Go play golf? Or I just couldn't think of anything. And so one day I was reading a book called Rich Dad, Poor Dad, which I'm sure everyone's heard of, and begin to learn the basics of real estate investing, or at least the benefits of it. And so I casually mentioned to her, hey, maybe this is something we could do together on the side, buy a couple rentals. And rather than having a hobby that takes money, this would make money. And so we got this brilliant idea. We were going to go save up our money, purchase a house, and be single family landlord. And so we began to save our money. And until one day she came in and told me we need to do something called a house hack, where we would basically leave our nice, comfortable house and move to a fourplex that we would renovate and use as our first investment property. And so that's exactly what we did. And so this was going on maybe about 4 years ago. And we live in the Dallas-Fort Worth area, specifically Arlington, for anyone that's familiar with this metroplex. And we purchased a fourplex right next to the Cowboys Stadium in Arlington. And unfortunately, while we thought maybe we would cash flow $300 or $400 a month on this property, because it had so much deferred maintenance, we were actually having to put in a couple $100 into it. And so while this wasn't going to break the bank, it was pretty disappointing when your first investment goes the opposite direction that you think it's going to. So we put our grindstone, so to speak, came up with some ideas and decided we were going to short-term rental or Airbnb out the units in the fourplex. And long story short, rather than negative cash flowing 300, we eventually got all four up and running as short-term rentals, and we're cash flowing positive about 3,000. And so that's when we hit our niche and off we went. So we spent the better part of the next couple of years building that residential portfolio that we use specifically for short-term rentals in Arlington, continue to build on that. But after a while, realized with all the kind of management and everything going on that it wasn't as scalable as what we were looking for long-term. And we also had a pretty unique situation where a lot of our friends and family who saw our whatever level of success we had at that time in real estate started asking us questions about how to get into it. And the unfortunate thing was they weren't necessarily wanting to be landlords or put up with properties or tenants or have those headaches. And so talking to a lot of the full-time investors at our local REIA meeting, they told us, hey, if you want to do this full-time, go into multifamily. That's the way to go. And so we began to learn about that and eventually joined a mentorship program, which I know you're familiar with, John, Michael Blanc's program. And lo and behold, several months down the road, we did our first multifamily deal going on a couple years ago. And now we've done several of them. I'm a full-time multifamily syndicator. I also am a coach in Michael Blanc's program now and completely sold out on it. And so that's the whole story in a short nutshell.
That's great. So give us some of the main differences, like why the single family stuff is so much more management intensive or time intensive on your end, on the actual investor's end, versus going and scaling up and getting into the larger stuff like multifamily apartment buildings, things like that.
Yeah, that's a great question. So I think there's a lot of answers, but if I had to narrow it down to one, it would be economies of scale. So if I have one single family resident and I have a maintenance problem, I have to hire a plumber, an electrician, whoever I need to come out, charge me full amount. I have to coordinate them coming to the property. It's going to be very expensive. And so it winds up being very costly, both from a time perspective and a money perspective. If I have a 100-unit property, on the other hand, the financials on that property will support me having a full-time property manager that takes care of the business side of the apartment, that leases the apartments, that coordinates all those things I mentioned, and also a full-time maintenance person to take care of a lot of those sort of nuisance items that pop up. And so it's a lot more efficient from an expense perspective, being able to have a property that supports that full-time staff as opposed to having to piecemeal out little parts here and there. And that's really what it comes down to, is just being able to have the staff, or being able to pay the staff needed to properly manage your.
Right. I love that you mentioned when you were getting out the house hack. I think that is just such a powerful way for people to get started investing in real estate. If I, knowing what I know now, if I was going back before I bought my first house, I would have definitely bought with that in mind. Now I've got the family and stuff, and it's not the most ideal situation to get started with doing that. But on the note of starting out, what are your thoughts on jumping straight into the larger stuff with multifamily versus there's a lot going around out there where you got to kind of started small and then work your way up. How can you get directly into the bigger stuff?
That's a good question. And some people tend to have a very dogmatic opinion about this question. I personally don't. I think that you can go either route if you want to, as long as you're really honest about what obstacles you may or may not face going either route. Obviously, starting out with the single family, if that's the route you choose to go, you're going to have a lot of those headaches when you start out. You're going to have those responsibilities. But the nice thing is you gain a lot of experience. You gain experience learning how to manage tenants, how to lease a property, things about renovation, about the mechanicals of a property, stuff that is a little bit more difficult to get when you're just handing the baton off to someone else right off the bat. So that's the positive. A lot of people mention that if you're looking for multifamily properties, brokers who sell multifamily properties and lenders who finance multifamily properties generally don't care about experience in single family, which is true. However, what I have found is that investors do tend to put some sort of premium on people that have had experience on their own in real estate before taking other people's money. So that's the positive if you go that route. If you choose to go the other way and jump directly into multifamily, I think the most important thing is your partnerships. It's finding people who are that 2, 3 steps ahead of you that you can learn from and that you can entrust to your investors without having to take all those risks and be on that learning curve by yourself. And for example, I mentioned all the mechanicals and the rehab and stuff like that. If you jump on a team with someone who has a lot of experience doing that, and maybe you're assigned the grunt work of doing the job, but they're there so looking over your shoulder, checking off the tasks as you go. I think that could be a great way to get into this business right off the bat, as opposed to going through the single family. So I think there's pros and cons to each. It's really just deciding, like, do you want to take on that learning curve and developing those relationships for the multifamily right off the bat? Or do you want to get your feet wet and then go on from there?
Yeah, I was speaking with a gal yesterday about a similar topic, and there's no one size fits all approach. I think you got to buy what your goals are longer term, and then I think either one of these niches will help to mold or help to get you to those goals. Like for me, I started off, I got interested initially in single family, but the more research I did, it seemed like there was a trend, as happened to you, like the scalability. People eventually start getting into the multifamily stuff after you hit a certain amount of single families. For me, that is what I did, straight into the multifamily stuff. And I did get into a mentorship program and work with partners to get in my first deal. And I think that is such a great way to avoid lots of mistakes. But regarding longer term goals, was it always the goal for you coming out of college and when you were a W-2 worker, was it always the goal to become a full-time real estate investor?
No, it wasn't. And in fact, I would say it's hard for me sometimes to relate to people who they start out day one in real estate, like, hey, I'm doing this full time and stuff. Because my transition, I would say, was very organic, thought out, but very organic. As I already mentioned in my story, we started investing in real estate just because we wanted to do something different than the stock market from an investing perspective. and we wanted to have a hobby together. Those were really the only two motivations. There was no plan of owning some huge portfolio, doing this full time. But the more that we got immersed into this industry and realized the opportunities that there are, the more I felt drawn to doing it full time. For me, working as an aerospace engineer, that's my background. I worked 8 years full time as an aerospace engineer. People are very passionate about that industry. They like what they do as a whole. And not very many people like to leave the industry once they're in it because it is difficult to get into. But what I found that was discouraging was in the corporate world, which is obviously where most engineers work. You put in extra effort, you go above and beyond, and then you get to your end of the year performance review and they're like, congratulations, we'll give you a 4% raise instead of a 3%, when you've worked double the hours and traveled weekends and all this kind of stuff. And you can do that for a few years, but then you start to say there's got to be something more for the level of effort I'm putting into it. And what I like about real estate is that, yes, there are risks. Yes, there are challenges, but if you're willing to take those on, you can be rewarded for doing so.
Kudos to you for recognizing that. And I have similar feelings about the W-2 world. I'm still in the W-2 world. I have a great job, love the people I work with. But yeah, you start to hit a point where you're like, is it the amount of effort I'm putting into this for the compensation, for the bonus that I'm getting, for the raise that I'm getting? And I think most people feel like that over time, but they'll just get bitter and stay where they are and not do anything about it. And then there's the few that actually do something about it. And I think real estate is one of, if not the best ways to slowly transition yourself into a life where you can be compensated based on your efforts and the merit and the value that you're providing. So you mentioned the stock market. So what was it specifically about the stock market that made you want to diversify into real estate? Or was there something specifically you didn't like, or was it just a diversification piece? What was going on there?
Yeah, I graduated school in 2013, started working full time right away. And then I started in real estate about 2000, early 2018, let's say, somewhere around there. And so the reason I say that is the stock market was doing well during that entire time frame. In other words, as I would put money into my company's 401k program, I was getting solid returns. But there were a couple of things that bothered me about it. I've always been someone, obviously being an engineer, we're dot every I, cross every T kind of people. And so I always had this question of like, why is it that my 401k is going to provide for me when I'm ready to retire one day? Or stated another way, how do I know that it's sufficient to provide for whatever level of living that I want? And that was always a question I had that my financial advisor couldn't really answer for me. No one in the custodian group that my company used could answer for me, right? And as an engineer, it's like, okay, something's wrong here, something's wrong. And so it wasn't so much the method as it was just the lack of transparency and understanding of how the investment worked. And then I would say my lack of control over it, right? I don't control what these leaders in companies do, the CEOs. I don't even control what politicians or anyone else does that sways the stock market one way or another. And so that was always very concerning to me. Now, I personally believe there are people out there that make great money on the stock market because they've taken the time to study it, they understand it, and they play the game, and that's great. But for me, I found real estate to be something that I could understand, that I could have direct control over, and that tends to produce good returns no matter what the economy's doing. So let me give you an example. Right now, we're either in the beginning of a recession or about to be in a recession, depending on who you talk to. And people in the stock market are pretty fearful right now. For me, all my properties, they're cash flowing. I get checks from them every month. If I had to sell a property right now, it would probably be slightly discounted from what it was if I'd sold it a year ago, but nothing like what the little bit of money I still have in the stock market has been discounted. And so for me, it's a big win. It's a risk against inflation. It's a risk against downturn that I think is worth considering for anyone that wants a safe investment.
Yeah, absolutely. I agree with you on all points there. So let's get into syndication a little bit. What about leadership in syndication? Let's talk about you're bringing other people in on this investment with you when you syndicate a deal. If you're new to syndication, if you're a listener, syndication, easy way to understand it is the pooling of resources of capital together to purchase a larger asset like an apartment building. There's the general partnership side and there's the limited partnership The general partners put the deal together, and the limited partners are the passive investor. So Jonathan is now on the general partner side of this. And how important is leadership and making sure that your priorities are aligned with the passive investors? And what are some ways to do that?
Yeah, so that's a great question. And honestly, I think it's something in the syndication world that's not talked about as much. So we talk a lot about the technical components of syndication, right? How to find deals, how to raise money, why apartments are a good investment. We don't talk as much about the soft skills or the people skills that go into it. So for me, I grew up, I've always liked being on teams. I've always liked leading teams, especially on really challenging projects. That's what I did when I was in school that I really excelled at. That's what I did in the corporate world was I was basically a project manager over a lab and led a lot of big projects there that included numerous people contributing and very strict deadlines and requirements. And so I think that there's a lot of parallels there between that and the syndication world in the sense that, yes, you have to be able to find a good deal. Yes, you have to be able to raise the money for the deal. Yes, you have to be able to find a property manager, make up a business plan. But what's the glue that brings all those things together? And I would argue it's the leadership and teamwork, specifically of the GP team. So, as a lead sponsor on a deal, after you found a deal, you have to be able to work with the broker and the seller as you're going through that acquisition. You have to be able to work with a lender, and commercial lenders are notorious for being a little bit more strict than your residential lenders are. So that can be challenging. You have to be able to work with the other GPs, co-GPs on your team. And then, of course, with your property management on the property that you're executing the business plan on. And to me, those people skills, those soft skills that go into the projects are perhaps the most important thing that really brings a team together and makes a project successful. Because real estate in general, it goes up over time. Rents go up over time. People recognize the value of real estate, but it's a GP team that's well organized, that functions well together, that ultimately, I believe, makes most projects successful or not successful. So I think leadership's crucial. To answer your second question about alignment of GP and LP interests, it's one of those things that we in this industry we talk about a lot. But until you've been in a situation that maybe has not been as ideal between GP and LPs, it's hard to truly empathize with. And so I've been fortunate that every GP team I've worked with has been outstanding. I've been the lead syndicator on projects, I've co GP projects, they've all gone well. I'm very thankful for that. But I have had LP investments where I don't feel the GP team was reaching their full potential, let's just say. And it's very disheartening to see that when there's so much at risk and so much trust that's being misplaced. And so to me, that's a primary thing that I look at when putting projects together is, does this project align with interests as an LP? If I was only investing money, would I invest in this project myself? And I think it's something that without it, you're not going to survive in this industry.
Yeah, and you mentioned a couple great points there. One of them being said that it's been relatively easy. People have been making money a lot over the past few years. Pretty much if you invested in real estate over the past decade or so, it's pretty likely that you were making some decent returns on that. Now we're hitting a point where maybe that's not so much the case. So what are some things for passive investors to look out for as they're thinking about analyzing a deal or a potential sponsorship team? What are some things to look out for?
Yeah, first of all, I think as a passive investor, one thing at least I encourage my investors to do is to educate themselves on the industry. And I've already mentioned that one of my big reasons for going over to real estate was I wanted to invest in something that I understood. And I recognize everyone has different interest levels when it comes to how much they understand. I have passive investors who understand more than I do. And I have passive investors who they knew absolutely nothing about investing. And we started from the ground on their education in that and brought them up to a level where they were sophisticated enough to be able to participate in a project. And I think that the biggest things to look out for is that recognize there's two ways people have made money in real estate over the last few years. One is executing on their business plan, which involves taking the NOI of a property at one point and raising it to another point. And then another is compression of cap rates. And so if you can look not only at a person's track record, how much of those returns came from each of those two things. In other words, did they actually hit the NOI targets they were going for? or did they just make money based on the compression of cap rates? You can get an idea of what their success might look like in a less than ideal economic environment. So that's one thing. Another thing that I'm telling a lot of my passive investors right now, and this is extremely based on my opinion from what I've read and understand about economics and historical data on real estate investing. The Fed's raised rates in order to combat inflation, and they've done so at a rather historic pace. No one knows exactly when they're going to level off, but most people believe sometime Q1, maybe early part of Q2 next year, they're going to take their foot off the gas and let things coast and see where it goes. If you also look at historical data, you'll see that on average, somewhere around 1 to 2 years after they level off, they'll begin dropping rates. And they really have to for a number of reasons. One is because of the amount of debt that our government actually owes. So the person that has the highest debt service is our own federal government. And so they won't be able to keep rates where they are forever. It has to be transitory. But then I think the second thing is that in the same way that due to inflation, the Fed had to raise rates and cause a recession, they will then have to likely lower rates to get us out of said recession. And what we're most likely looking at, in my opinion, is another probably 18 to 24 months of turbulent economic times and difficulty from a borrowing perspective. And then we'll go back to lower rates and a more reasonable market again. So if you believe that, then now is actually a great time to invest because you're going to get the lowest price point on your property that you're ever going to see because property just keeps going up. And then you can either sell or refinance eventually in the future when those rates come back down. We don't fully bank on that in our underwriting, but it is something I ask investors to consider as they're making investment choices.
Yeah, you marry the property and you date the interest rate, right? You find a good property,
Absolutely.
get a good price on it, and maybe it's not the most ideal interest rate, but eventually that's going to change. If the interest rates keep going up, then you bought at a decent interest rate in theory.
Yep.
And if they go back down, then you can refi into that and you still got the
Yep.
property. That's great. So I want to talk a little bit about getting out of your comfort zone. Naturally, as you progress up into larger properties and dealing with syndications, investor capital, what are some of what have you done well as far as getting out of your comfort zone? What have been some of the keys to your?
Yeah, so it's interesting because I mentioned my background is engineering, and going through engineering school, I was always out of my comfort zone, always pushing myself. I was not a naturally talented student. I was a student that got through school just based on work ethic and sheer levels of effort. So I think that's one thing I had going for me to begin with. Another thing, and my wife would laugh if she was listening to this right now, but my hobby, my real hobby outside of work is running and triathlon. It has been for over a decade. And for me, the idea of getting out of your comfort zone, the idea of pushing yourself is something I do every day in my hobby. And it's interesting because I think that the sort of norm in our culture, in American culture today, is just be comfortable, right? Just stay where you are. Yeah, it may not be that great, but it's not that bad either. So you just stay where you are. And my perspective is that if you're not willing to go to those uncomfortable places, you never hit those really great places. And so that's what I would ask everyone to consider, whether you're looking at being a GP or just an investor and you're scared of making an investment. Getting out of your comfort zone is tricky because you have to be brave enough or have enough courage to be able to get out of your comfort zone, but you also have to have enough wisdom to not be stupid. People really do lose money in this industry. Investors really can be disappointed in their investment choices. And it's getting out of your comfort zone is not about just going out and doing something dumb, but it's about when that right opportunity comes and you know it's the right opportunity, not holding back because of that fear. And I think it's something you have to train yourself to do. Everyone does it differently. I mentioned for me, running is a big part of how I do that, but then also working through real estate. I remember the first night we went to sleep when we moved to our fourplex, which was not as nice as the house that we lived in, was in not as good of a neighborhood as what we lived in. I remember going to sleep that night and thinking to myself, like, if we make it through this, like, we're going to be successful in real estate. This is the inflection point, if you will. And since then, it's just everything else is just one more challenge to overcome. And we're trying to just do that with prudence for our investors and ourselves, but we're not going to back down from an opportunity.
Excellent. What's something you wish you would have learned about real estate investing sooner?
I think how accessible it is. So it's funny. We didn't start out investing in single family homes because we looked at all our options and that's what we wanted to do. We did it because that's all we knew about. And so there's a very good chance if someone had pulled me aside at my first RIA meetup and said, "Hey, do you like dealing with angry tenants? Do you like changing out toilets? You can invest passively and have to do none of that." I may just be a passive investor today. I honestly, it was ignorance that let me start down that path originally. And fortunately for me, I love it, but that's not the case for everyone. Not changing toilets, that is, being an active investor, of course. But I think that the accessibility of real estate is something that a lot of people don't know about. And passive investing is a tremendous opportunity. When you look at the difference and the risk profile of being a passive investor in a multifamily project versus the stock market versus your own single family home and how little time is involved in it, in my opinion, there's nothing that beats it. It's just about finding a good sponsor, investing in a good market, a good property, and then forgetting about it, minus reading your investor updates. So I think that I wish I had known how accessible that it was to me. It wasn't something you had to be rich to get started, and it wasn't something that you had to spend 10 years learning about to be successful. And it's something that anyone can do if they're willing to just put a little bit of conscious effort into learning about it.
Yeah, man, absolutely. And one thing I wish I would have known on that note, covered it, but you don't need to have money. It's nice. You can make more money the more money you have, but you don't need it to get started. You can put in that sweat equity. You were mentioning Rich Dad Poor Dad. Robert Kiyosaki talks about working for free. Go up to somebody who has more experience and see if you can provide them some value, take some things off their plate that they don't want to do. I meet so many young investors getting started now who are doing just that. And I wish I would have known that when I was younger, and it would have just made such a difference. But you've mentioned RIAs, the networking groups, multiple times. How important has networking been, and what kind of, speaking of getting out of comfort zones, that's something that definitely took me a while to feel comfortable doing. And I'd be lying if I said I never pulled up to an event and then turned around in the parking lot because I was feeling a little weird about going in. But how important has building your network been as far as real estate investing goes?
Yeah, first of all, in engineering, we don't network. I barely knew what the word meant when I got started in real estate. It's been critical. The purpose of networking is it lets you go a lot further than what you can do on your own. So, yeah, I can go out and just buy single family houses and Google a lender, Google a property manager, whatever on my own. But when you take the time to go out and meet other people who have already done what you're doing and you can learn from them, or meet people who could be potential partners, vendors, people that you're working with, that greatly accelerates your progress. In my mind, that's one of the big purposes of networking. I would argue the other one is just enjoyment of life, getting to know other people and have those relationships. So for me, we talked about leadership. I've always been a big proponent. I feel like that's something I'm gifted in, something I like to work on is leadership and teamwork and stuff. But the idea of just going in blind to a group of people I don't know and starting conversations has never been something I've been comfortable with. And so even to this day, it doesn't feel natural, I would say, when I go to a brand new event and do that. And I sometimes sit back and ask myself, like, why is that? Why do I feel that way? And I think there could be a lot of different reasons. I think sometimes it's almost an imposter syndrome. We walk into an event and we think, "What else here has the answer except for me?" And that's rarely the choice, right? If you walk into a room, there's most likely a good number of people who know a lot more than you do. And there's most likely a good number of people that know a lot less than you do. I think that's one thing that holds us back. And I don't know, it's something that kind of goes through my mind a lot. But I actively work on going out and meeting new people. One of the things I really focus on now is not just meeting the people, but developing quality relationships. And so it gets easy if you go to these networking events to get distracted or pulled aside by another lender that just wants to talk to you and give you a loan, or someone that basically is just in it for their own personal gain. But when you find those good quality relationships, it's important to keep developing those and making something of it so that you can take full advantage of those networking opportunities.
So as an underwriting coach, that is what you're focusing on now, or one of the many things that you spend your time doing. What is something that people, when you're underwriting a deal, what's one thing you would caution folks to look out for in their underwriting right now with the changing and uncertain economic times?
Yeah, that's a tough question to answer because there's so many things that can derail you. Multifamily underwriting, it's simple, but there are a lot of pieces to it. I think that probably rent growth and debt terms are two things I really see a lot of problems with right now. We've had when I started in multifamily here in Dallas, we would underwrite deals depending on the area and stuff with rent growth of 3% per year, 2.5% per year. And this is a primary market here in Texas. And now, because we've had double digit rent growth for over 2 years, I see a lot of sponsors not only underwriting the next 1 to 2 years with significant rent growth, but even 3 or 4 or 5 years out. And you can take credit where it's due, but I think that when you see how the Fed is pushing rates, they're doing that to combat inflation, and rent growth is directly tied to inflation. And so they will be successful in bringing it down. And when it comes down, rent growth will go back to more historical norms. And so I would really caution people about underwriting deals with excessive rent growth, especially in years 3 to 7 of a business plan. I think that's one big thing I see. Obviously, debt, although now I'm almost like, hey, we're nearing the top of that curve to where you should have been looking out for it a year ago. But today, I don't think it's as risky as what it was a year ago. Probably the other thing would be cap rates. Cap rates, brokers, lenders, even a lot of economists are like cap rates will not go up beginning this year. They will not go up. They cannot go up. And lo and behold, they have gone up. If you sell a deal today and it has the same NOI that it had a year ago, you will sell it for a lower price. End of the story. And you have to be cognizant of how much longer is that going to go on, and where do you believe cap rates are going to go once rates start to come back down. So I know that's not one thing, but I have a hard time narrowing it down. So there you go.
Hey, that's great. I love it. Jonathan, got time for one more question. This is a question I ask all of my guests. So as a quick refresher, I work at Diablo Canyon Nuclear Power Plant, currently set to shut down in the next few years. And my purpose is to replace my W-2 income from my job at the plant with income from real estate investing. So what's your one piece of advice you would offer to folks who are looking to escape the W-2 world and make their money with either real estate investing or entrepreneurship?
Yeah, I would say take action and do it sooner rather than later. Most students who I see that are, let's just say, less successful, or most people who are interested in this that are less successful, it's not because they made a poor decision. In fact, I actually know a lot of people that have been really successful in real estate that have made a lot of bad decisions and they're still successful. It's just because they don't do anything. I think that one unique thing about this journey for me has a big part of my why is helping people to live the full potential that they have in their life. So it's not just about making money for passive investors, although that's obviously the high level plan of what we're doing. It's about giving them the freedom to go live whatever their calling is and to make a difference in the world. One thing is we don't know how much time we have alive, right? Like we don't know how long we have to spend with someone. We don't know if we could get hit by a bus tomorrow. And so for me, it's almost irresponsible to just sit back and just do nothing, whatever it is that you've been called to, whether it's investing or helping someone out, or maybe it's just a career change that you want to do, whatever it is, take action, because if you don't, you'll be in the same place a year from now that you are today and no closer to your goal.
Yeah, that's a beautiful outlook. I love it. Where's a good place to go if folks want to get in touch with you and hear more about what you're doing?
Yeah, absolutely. Our website is a great place to learn about us. It's www.apogeemfc, like multifamilycapital.com. And there we have all kinds of resources about multifamily. We have a free ebook that you can download and learn about passive investing in multifamily. And then also LinkedIn. I'm very active on LinkedIn. I'm sure if you're friends with John, you can find me, and I would love to chat with you if you reach out to me there.
Excellent. All right, Jonathan. Well, I really enjoyed this conversation today and hope to chat again soon. Thanks so much.
Sounds great. Appreciate you having me, John.
Thank you for listening to Freedom Investor Radio. If you like what you heard, make sure to rate, review, subscribe, and share with a friend. Thanks again for listening.